Welcome everyone to our second BUSSQ annual members meeting. My name is Paula Masters and I am the chair of the BUSSQ Board of Directors. I would like to officially open the annual members meeting for the 2020-21 financial year by firstly acknowledging the Turrbal and Yugara people, the traditional custodians of the land on which we meet today, and to pay my respects to their elders, past, present and emerging. I would like to acknowledge and welcome my fellow BUSSQ directors here today. Sonia Byers has been a director since January 2018. She is the chair of the Audit, Governance and Compliance Committee, chair of the Risk Management Committee, and chair of the People, Culture, Remuneration and Nominations Committee. She is also a director member of the Investment Committee. Paul Bidwell is present with us here today and has been a director for over 6 years. Paul is the chair of the Insurance Committee and also a member director of the Investment Committee. Next we have Jackie Colley, who has been a director of BUSSQ since August 2019. She is a director member of the Investment Committee, the Insurance Committee and the People, Culture, Remuneration and Nominations Committee. Newly appointed to our board and unfortunately unable to join us today is Madeline Dermatossian. She has board experience gained as a non-executive director in government, trustee and private sector organisations. Finally, Michael Ravbar has been appointed recently to our board. He is an experienced director holding numerous directorships within the building and construction industry. I would like to thank the directors for their dedication and support of BUSSQ's members' interests. Also joining us online is David Jewell, representing our company auditor Ernst & Young. David has been with EY since 1984 and a partner since 2002. He is a registered company auditor and meets APRA's fit and proper requirements for superannuation auditors. I'd like to say thank you to all the members who are online today for our annual members meeting. The purpose of this meeting is to give all BUSSQ members information about how the fund has performed in a difficult and challenging economy, changes to super law during the year and how we have implemented them, and the fund's future direction and plans to deliver for members. We hope that you leave the meeting feeling a little more knowledgeable about BUSSQ. This meeting is about you, the member. Members are at the centre of everything we do at BUSSQ. We are a profit for member fund that always acts in the best interests of members. Every decision and every activity we undertake is based around what will be the best outcome for you. This event is one of many events undertaken by BUSSQ this year. Our strategy is to give members the right information at the right time, with access to subject matter experts and to the executive team. Speaking of the executive, our Chief Executive Officer, Damien Wills, is unable to be with us here today. Instead, our Chief Investment Officer, Simon Mather, will be stepping in to provide you with a funds update. As the Chief Investment Officer of BUSSQ, Simon will also provide you with an investment update. After hearing from Simon, we will devote the rest of the meeting to addressing your questions. If you have a question you would like answers, please use the chat box at the bottom right-hand corner of your screen. It is possible that we may not be able to answer all your questions today. However, the minutes of today's meeting, along with a recording of the meeting, will be published on the BUSSQ website. The minutes will include all the questions received before and during the meeting, along with their answers. As with all member meetings and seminars such as these, we are required by legislation to let you know that the information presented here during this meeting is general information only and does not take into account or consider your personal objectives, financial situation or needs. Before acting, you should consider the appropriateness of the information to your needs or seek independent advice from a properly qualified professional. We would also like to remind members that past performance is not a reliable indicator of future performance. BUSSQ's investment returns quoted are after tax on investment earnings and after indirect costs. At today's meeting, we will not be able to answer any questions that we receive that are of a personal nature. These could be questions relating to your personal circumstances, such as a claim that is underway or requests for advice on investment choice. However, if you do have a question pertaining to your individual account, we encourage you to reach out to BUSSQ. My job, and that of my colleagues on the board, is to ensure that BUSSQ members retire with dignity. Delivering dignity means delivering financial products and services that support you all the way through your working life and beyond. The fund was recognised for our efforts by Super Ratings again this year. Our MySuper, Premium Choice and Income Account products were awarded Platinum ratings for providing the greatest potential to maximise members' retirement savings in a well-serviced, secure environment and with a well-priced benefit offering. The government's Your Future, Your Super reforms came into effect on 1 July 2021 and has been a key focus for the fund's leadership. Under the reforms, the Australian Prudential Regulation Authority, or APRA, is required to conduct an annual performance test for MySuper products. The assessment under the performance test, in conjunction with the ATO's Your Super comparison tool, is intended to hold superannuation funds to account for underperformance through greater transparency and increased consequences. BUSSQ members will be pleased to know that their fund passed this test. Those funds that failed the performance test had to advise their members that they are in an underperforming fund and should consider moving to a better performing fund. The Your Future, Your Super reforms aim to have only one super fund per person. If this outcome is achieved, it will be a positive change for superannuation fund members to avoid paying fees on multiple accounts. For super fund trustees, these funds also incorporate a revised member best interest duty, moving the focus of this duty to demonstrating fund expenditure is in the member's best financial interest. BUSSQ has over $5.92 billion in members' retirement savings under management. We've always punched above our weight. Since inception, as at 30 June 2021, we returned an average of 9.7% on the Balanced Growth investment option. In the last financial year, we have delivered for members our highest return in over 10 years. Our Balanced Growth Super option achieved a 10-year high of 17.28%, and our Balanced Growth Income Account option returned 16.61% for the 2021 financial year. Simon Mather, Chief Investment Officer, will provide a more in-depth investment update later in the meeting. It will include more information on short, medium and long-term returns across the BUSSQ's investment options. Over the past year, we have seen many superannuation funds joining together and combining resources. In response to challenges facing an increasingly competitive superannuation industry, BUSSQ is also looking at opportunities to increase scale through fund growth. An increase in scale would improve efficiency, and revenue growth can provide members with benefits such as lower fees and enhanced products and services. We will be sure to keep BUSSQ members informed of any significant outcomes that will affect you. December 2020 saw a change to the executive leadership team. CEO Linda Vickers retired after 22 years at BUSSQ. Damien Wills was appointed CEO and took the helm on 1 January 2021. Damien is only BUSSQ's fourth CEO appointment in our 36-year history. Damien is well placed to lead BUSSQ in executing the fund's strategic plan and has a long track record in the superannuation industry. He has proven to the board that he has the leadership and strategic vision to guide BUSSQ into what is a complex but exciting future. I would also like to take this opportunity to thank Damien and the entire BUSSQ team for their ongoing commitment to members, and particularly for the support they have provided for our members through the challenges of this year. Lastly, we would like to thank each one of you for your membership of BUSSQ, and we take this opportunity to affirm our commitment to putting your interests first. Now I would like to hand over to Simon Mather, Chief Investment Officer, who will be presenting the fund update on behalf of CEO Damien Wills. Thank you.
Thank you, Paula, for providing that update. It has been a true team effort over the past year. The board and staff of BUSSQ have continued to work hard through a year of great legislative change to ensure the fundamental reason for our being, you, our members, are at the very centre of everything we do. In 2021, BUSSQ celebrates 36 years, having been created in 1985 to serve the specific needs of the building, construction and allied industry workers in Queensland. Over this time, our membership base has expanded to comprise of workers from a range of other industries across Australia. Our membership has grown to 68,612 members, and we're currently sitting at just over 6.1 billion in funds under management. One of the biggest changes that we have faced, undoubtedly, is the coronavirus pandemic. This has put enormous pressure on families, individuals and businesses all over the world. BUSSQ has not been immune to the impacts of the global uncertainty. Despite this, during the pandemic, we have achieved some excellent results in key business areas, which I will now tell you about. Ensuring advice and support was available for members who suffered financial hardship as a result of COVID-19 was important for us again in the 2020-21 financial year, especially with the government's early release scheme. The scheme, which formed part of the government's coronavirus economic response package, ran through until the end of December 2020. And overall, BUSSQ paid $292.6 million in early release payments to support members through financial hardships suffered as a result of COVID-19. We know that through government research, these payments have helped members pay household utilities and to pay down debt. The release of these funds, which gave those in need early access to their super, had the potential to negatively impact a fund like BUSSQ. But thanks to robust prudential management, we emerged at the end of the financial year in a very strong position, and we are now looking ahead to the future. Despite the financial outflow due to the early release scheme, BUSSQ has achieved an excellent result, providing to members the strongest return in over 10 years on our balanced growth option. As Paula mentioned, our balanced growth option, super option, achieved a return of 17.28%, and our balanced growth income option delivered a strong return of 16.61%. Later on, I will provide you with more information around the investment performance, which will include information on short, medium and long-term returns across all of BUSSQ's investment options. As a profit to members fund, BUSSQ is committed to growing its membership and funds under management for the benefit of all our members. And looking back over the year, it's great to know that we're delivering on this goal, as we welcomed over 7,000 new members into the fund. In response to growth in Queensland construction industry, employer and member contributions also increased last financial year. Over $304 million was applied to our members' accounts. Growth has led to our average member balance also increasing. The average balance is $87,373. This growth places our members in a better position for their future and helps to improve their retirement outcomes. BUSSQ is committed to delivering value to members in the right way, with member outcomes at the top of our mind. Therefore, we undertook a member survey in 2021 to find out what else our members wanted from us. We make it a priority to gather information and feedback from members in order to continue to provide and improve on products that we provide to you. The member survey informed us that many BUSSQ members have one or more super fund. At 30th of June 2020, according to the Australian Tax Office, there were around 4 million people holding 2 or more super accounts. 10% of our BUSSQ members are in this group. BUSSQ has implemented an online portal where members can, if they wish, search the ATO to find and combine their lost super simply and securely. Consolidation of super accounts means that members can reduce additional account fees and charges incurred by having multiple accounts. More than half our members told us they joined BUSSQ on the recommendation of their employer, with another 17% joining on the recommendation of a colleague or friend. Being an industry fund with a proven long-term track record with strong ties in the building, construction and civil industries is one of our strong suits. BUSSQ has a team of dedicated member representatives who provide personal service to employers and workers in the industry. They are supported by an administrative team whose purpose is to make the difficult easy for our members. It is a principal value of our membership. It is a principal value of BUSSQ to provide a high level of personal service for our membership. We can see that this strategy pays off by our organic growth metrics and by the feedback we routinely seek and act upon. In addition to our member survey this year, we regularly conduct satisfaction surveys to collect members' feedback and measure overall sentiment. We do this by using the Net Promoter Score, or NPS, Customer Experience Program, which reveals how we're performing against other companies and industries worldwide. Bain & Co., the source of the NPS system, suggests that above 50 is an excellent score. And I'm thrilled to say that our members consistently express a high level of satisfaction with their overall BUSSQ experience. When asked in our member survey how likely they were to recommend BUSSQ to a family member or friend or colleague, we returned an NPS score of 56. A fantastic result highlighting our team's passion and focus on helping members supported through their working lives and in retirement. Last financial year, our contact centre received an impressive score of 63 on average, showing members were very satisfied and willing to recommend us to others, a position we strive to be in. We also asked our members if they felt there was anything missing from BUSSQ's service offering. More than 3/4 don't see that we're lacking anything in our service suite. In fact, 81% of respondents see BUSSQ as better than other funds. Our members told us in the survey that their preferred method of being contacted by BUSSQ is over the phone or online. 77% of respondents prefer being contacted over the phone, while 50% prefer to use the website. This is valuable information to help us to communicate with our members in the way that best suits them, and we'll continue to tailor our service to make it more accessible to all of our members. We continue to look at ways we can better offer services to our members. As a result, we have recently transformed our financial advice model to deliver a more cost-effective and efficient solution for our members. Members can receive personal advice that is tailored to their own individual circumstances on contributions, investments, retirement options and insurance in relation to the BUSSQ products. This advice is delivered by Link Advice and is provided over the phone, which our recent survey told us is our members' preferred channel. The phone meeting is then followed up with a written statement of advice, showing the members how that advice puts them in a much better financial position. How much does this cost the member? There's no out-of-pocket expense. The fee is included in the trustee-related costs. Members who are seeking tailored retirement advice, which consider financial matters beyond their BUSSQ account, such as assets and income and eligibility for Centrelink benefits, can also receive this type of advice on a fee-for-service basis. And of course, BUSSQ employees continue to be out on work sites, in your lunchrooms, in offices, visiting our members and also providing them with factual information and general advice to help them get their super sorted. Our interaction with members includes daily face-to-face conversations, and last financial year we provided over 440 information sessions for members where they work, making our team and superannuation information accessible helps engage our membership base. As Paula mentioned previously, the superannuation industry in Australia has undergone significant changes since the fund's inception in 1985, and it could be argued none more so than legislative change over the last 12 months. The superannuation market is being transformed with a keen focus from regulators on improving outcomes to members, something BUSSQ has been focused on throughout its proud history. A key focus for the fund was Your Future, Your Super legislation. This came into effect on the 1st of July 2021. Paula mentioned this and talked about the implications for the super industry and for BUSSQ. A specific change affecting BUSSQ members is a key reform known as stapling legislation. Very simply put, this means that an individual's super account will follow them when they change jobs. The idea behind this legislation is to reduce the incidence of members having and paying fees for multiple unnecessary accounts. While the intention behind the legislation is a positive one, our relationship managers found that employers were not prepared for stapling and needed assistance from BUSSQ to understand what it would mean. The legislation represents a change to the onboarding process a business will have to administer when a new employer starts with a company. Through our relationships and our relationship managers and strong industry connections, BUSSQ is committing to helping employers with better understanding their obligations and compliance requirements. One of our initiatives to help employers understand their obligation and compliance requirements was a live webinar event we partnered with the ATO. Employers heard firsthand from the creators of the system, and the information has been distributed through our communication channels. It is one of the focal points of the present and future strategic plan to assist members through legislative change. We know that employers who comply with superannuation legislation obligations are well placed to provide their employees, BUSSQ members, a much better retirement outcome. And that is the reason BUSSQ exists. Your fund is maintained for the sole purpose of providing retirement benefits to members or to their beneficiaries if a member passes away before retirement. Members are at the core of everything we do. Legislative updates over the past year means there is an onus of reverse proof on funds to be transparent about how they spend members' money. This is a change that BUSSQ supports, as we have always acted in the best interests of our members as part of our core cultural value. The best interest duty underpins our strategic vision over the upcoming years. BUSSQ's fundamental strategic objective is to improve members' retirement outcomes. In doing so, we have resolved to continue to provide members with a high degree of personal service and to assist their employers to retain compliance with the obligations. BUSSQ's strategic vision for the future is based around our reason for being: a profit to member fund with a duty to act in the best financial interests of our members. We will continue, as always done, to represent and champion workers' retirement outcomes. The strategic plan is not just a theoretical approach to running this business, it translates to the practical operations of providing BUSSQ members with products and services tailored to the building, construction and civil industry in which the majority of our members work, and demonstrate that it is and continues to be fit for purpose. This concludes the fund update. I will now provide you with an update on BUSSQ's investment performance for the 2020-21 financial year. We are required by legislation to let you know that the information presented here is general information only and does not take into account or consider your personal objectives, financial situation or needs. So before acting, you should consider the appropriateness of the information you need and seek independent advice from a properly qualified professional. Okay, so on to the investment update. So the topics I'm going to cover today include, we're going to look back over the last financial year. I'm going to give you some information about how BUSSQ has performed. We're going to touch on the responsible investing that we're currently doing and looking to do over the future. I'm going to provide you with an outlook over the next 12 months and then just give you a bit of an update on where we are with performance. As initial lockdowns were released, we saw a rebound in trade and manufacturing in the second half of 2020. As shown in the graph, China has led this process, rebounding particularly strongly. Closer to home, we have seen the Australian economy go into its first technical recession in nearly 30 years. Even going back to 2008, Australia did not go into a recession when most of the world, major economies around the world, did go into recession. Our economy has actually performed relatively well and is now back, as shown in the graph, above pre-pandemic levels. We're just above the line. Towards the end of 2020 and into the early part of 2021, there was a lot of political instability, particularly in the US, with the presidential election. I'm sure you remember. The distributed victory by Joe Biden, the riot at the Capitol building, and the inauguration of Biden, and the impeachment or the acquitted impeachment of President Trump. After this, we saw the Biden administration actually announce a significant infrastructure spend and delivered a very large fiscal stimulus that has supported the US economy, as we can see in the graph. Additionally, the transitional period with the withdrawal of the UK from the Brexit ended on the 31st of December and is now operating under new agreement. This produced some uncertainty and material trade disruption around this period. During the 2020-21 financial year, we saw a significant rebound in share markets around the world. Share markets produced very strong returns over the financial year, although there was, as you can see in the graph, quite a bit of volatility. This was namely from geopolitical risks, but also COVID-related issues. Share markets benefited from the news of the vaccine developments towards the end of 2020. As shown in the slide, we can see the share market started to improve quite significantly. Share market performance was particularly strong in the US, and especially around the technology sector globally. During the September 2020 period, we saw a bit of a rotation out of some of those higher growth names, those technology stocks, into more value names, which are companies actually trading at lower valuation, lower share prices relative to their company performance, company fundamentals. Australian share market returns were not as high as the world equities over the financial year, but were still very strong, as you can see on the graph. So now I'll just talk a bit about the Australian share market. This graph shows the returns of the top 200 listed companies on the share market for the 2020-21 year, broken down in contributions by each sector. As you can see, one of the big contributors last year was financials. But nearly all sectors posted more than 25% gains, with the laggards being healthcare and consumer staples. The only sector to actually be down for the year was utilities, and that was led by AGL and Origin. Consumer discretionary and financials and IT led to charge, up 46% or so respectively. There was a wide dispersion in returns in the top 20 performers. Afterpay was the best performing leader, ending the financial year up 94%. Slightly ahead of iron ore producer BUSSQ, which was up 90, and Aristocrat, which was up 70. As mentioned earlier, the financials were a big driver of returns, and the big four retail banks made a significant contribution to the overall market performance, with CBA, Westpac, NAB and ANZ all chalking up returns of over 44%. Conversely, A2 Milk was the worst performing stock for the year, down 68%, and that was on the back of China announcing overnight that they would be stop buying their products. The Australian dollar generally appreciated over the financial year, reducing the return of unhedged equities. The exception was the pound, the British pound, as you can see on the graph at the bottom line there, which benefited from the removal of uncertainty. So the pound had been weak for quite a period of time. Removal of the Brexit uncertainty, we saw a bit more strength in the English pound. A key driver, although, of the Australian dollar was the rising commodity prices that benefited from the rebound in global growth, which we saw on a previous slide. Particularly strong demand from China. The iron ore price increased very sharply, more than doubling over the financial year. So what did we do during the year? Not too many changes this financial year, last financial year. We stuck with our strategy to invest for the longer term. So we maintained an increased overweight to Australian and global shares. So as equity markets or share markets started to improve, that overweight obviously added benefit to our members. But one of the things that we've been working on over the last few years is actually reducing fees. So returning more return to members. So we were able to reduce our investment fees over the year even further. So how did our asset classes perform? We saw strong returns from most asset classes outperforming their 5-year average, except for fixed interest and cash, and that was primarily due to the low interest rates. As you can see in the graph, the blue bars are the last financial year, and the grey bars are an average over the last 5 financial years. So particularly the first 2 bars there, Australian and international shares, both had significant performance. So you can see our Australian shares outperformed the benchmark, which was around 27.9%, by around about 5 or 6%. So some really strong returns from our Australian shares. Moving along to some of our real assets, so infrastructure, property and agriculture, and it was pleasing to see that they actually performed really well as well. So one of the things about BUSSQ is that we look to provide you with a nice stable return over time. So those sort of real assets which provide some sort of dampening effect on those equity markets, which we saw in previous slides, which have been quite volatile, provides a nice sort of smoother type of return. So this slide here provides you with the returns for the super and the TTI returns for the 2020-21 financial year. As you can see, the high growth option, which is our diversified option with the highest allocation to growth assets, returned just over 20%. Balanced option, as previously mentioned, returned 17.28%, and then the defensive option returned just under 8%. As you can see over the longer term, with the balanced option, which is our longest running option, over the 20 years, we've returned on average for members around that 7.5%. So really good long-term strong returns. Going down to the bottom 2 there, defensive, diversified fixed interest and cash, you can obviously see the returns there are quite muted, and that's due to very low interest rates that we've seen over the last 12 months or so. So moving on to returns for people in the income account or the pension phase. Similar sort of story as you would expect, high growth, highest allocation to growth assets. For diversified, return just over 22%, and the balanced option there, 16.6%. And again, pleasingly over the longer term, the funds continue to perform very strongly. So now I'll just take a moment to talk about the long-term returns of the balanced option since the global financial crisis. As you can see, this graph provides you with the annual returns over those 13 or so years, and we're comparing them against the super rating median. So super ratings is a rating agency that rates a lot of superannuation funds. As you can see, over the 2021 last financial year, where we returned about 17.28%, we were slightly below the median. But if you go back 1 year to 2020, as you can see, that year was significantly outperformance. Where I think the median return returned just under 0.5% or negative 0.5%, we returned about 2.4%. So as I said before, one of the things about BUSSQ is we're trying to provide you with a much stable return over time, and part of that's partly driven by our allocation to those real assets. So now I'll just talk a little bit about some of the areas of responsible investing. So this has been our 3rd year of measuring ourselves against those 4 Sustainable Development Goals. So the United Nations has put out 17 Sustainable Development Goals aimed at actually improving the world to be a better place for everyone. So we've chosen 4 Sustainable Development Goals to focus on: the affordable and clean energy, decent work and economic growth, sustainable cities and communities, and of course climate action. As you can see, between 2019-20 in general, we've increased our allocation to these Sustainable Development Goals. So that was a good year for improving our exposure to these 4 Sustainable Development Goals. During the year, we also assessed our managers and how they're monitoring and managing climate risk. And the result was pleasing to see that they were aware of the risks within their portfolio and able to articulate them to us well. The majority of BUSSQ's managers have a good understanding of climate risk and how it can impact our portfolios. There are a few managers, however, that have fallen slightly behind the peers, and that enables us to engage with them much more in depth. Pleasingly, this cohort of managers represents a relatively small exposure to BUSSQ's overall portfolio. Most managers were able to self-report on climate regulatory risk, physical and stranded asset risk at an asset level. These self-reported risks were generally low with few exceptions. Those managers that reported a higher level of climate risk in their portfolio were generally assessed to have suitably rigorous processes for managing these risks in line with peers. The findings of this exercise show that BUSSQ's managers, for the most part, are doing a reasonable job of assessing and managing climate risks. The real value of this exercise will be to track the evolution and improvement, and this is what we will be doing over time. Additionally, this year, we will also be performing a baseline assessment of our carbon footprint, assessment across our share portfolio and also our fixed interest portfolio. We're already looking at ways of looking to reduce this through our equity portfolio. So now just highlight one of the areas where one of our managers is actually putting this into practice. Robina Town Centre, shopping centre on the Gold Coast, is home to the largest rooftop solar array in the southern hemisphere. It's got over 13,000 solar panels, generating 5,500 kilowatt power every hour. Enough energy to power 1,205 homes or charge 755 million phones per year. The manager QIC is also looking to achieve net carbon zero target emissions by 2028 across the whole of the retail portfolio. Another area that we're looking at, one of our managers is looking at across the ESG space, is actually within our agriculture portfolio. In Australia, agriculture contributes around 13% of total greenhouse gas emissions. So this is an important area where we look to reduce. So one of the things they're looking at is looking at feed additives for cattle to try and reduce the methane output, looking at different crop seed varieties which requires less irrigation, and also looking at next generation machinery. So making sure that the machinery that we're using is more efficient. Other areas we're looking at is soil carbon, so carbon sequestration. So being able to absorb carbon out of the atmosphere into the earth. And also looking at regeneration of parts of the country. So now I'll just take a bit of time to look ahead and focus on some of the things that we're thinking about when we look at your portfolio. Unsurprisingly, coronavirus is still with us and is one of our most important areas that we're looking at. The variants are becoming more transmissible, but also global vaccination rates we're looking at. The financial year has been dominated by COVID-19 again. After the initial outbreak and lockdowns, there have been subsequent waves of these new infections, including in late 2020 in the US and Europe, and in India around April 2021. COVID-19 spread has been relatively minimal in Australia, but as Australia has experienced a number of outbreaks and lockdowns, particularly in New South Wales and Victoria. The major development in late 2020 was the approval and release of an effective vaccine. The rollout of vaccines through 2021 has been divergent, with some developed markets easily gaining access to these vaccines. However, in some regions it has been quite slow, particularly in many emerging market countries. New mutations of the virus, as well as a vaccine hesitancy and availability, means COVID-19 is likely to remain in circulation for some time. Another area is inflation. So we've seen the easy part of the recovery, that's behind us. So now we're trying to transition into the economic cycle from that supercharged growth area. Inflation is obviously one that's been talked about a lot. Here in Australia, the RBA has always talked about targeting an inflation between the ranges of 2 and 3. We're currently sitting above that, But in some parts of the world, the inflation has gone much higher, particularly in places like the US and Europe. So the vast sums of fiscal and monetary policy that have been used to support the economy have shortened the cycle, the economic recovery cycle, but increased the amplitude. Also, one of the effects of impact on inflation has been the slow global supply bottlenecks. Fears of also consumer price increases, and we've also seen bond yields move higher as well. So just touching on central banks around the world, monetary policy remains highly accommodative, as central banks advise that considering rate hikes and the succession of quantitative easings would be premature. However, there's been noticeable slowdown in the pace of bond purchases by central banks across major banks. The exception has been the RBA, which has continued to expand its balance sheet at a relatively fast pace to achieve its target. Monetary policy is providing very supportive financial conditions, but is no longer easing. Credit availability still remains high, but the rate of credit growth is moderating after the initial spike we saw. And there are some signs of tightening of lending standards. Just recently, we've seen the Reserve Bank in New Zealand increase their rate. We've also seen it in Brazil and Russia. So just focusing on those global debt levels, as I said previously, fiscal stimulus has been a key support and remains highly accommodative. There have been further large stimulus packages, and as mentioned previously, in the US with infrastructure, but also their job plan and families plan, proposed under the Biden administration to support the US's long-term growth. As seen in the first bar there, that's the US. So we can see over time that we're expecting these fiscal stimulus to be withdrawn and debt to be paid down. Most countries are forecast to have decreasing deficits in the years ahead, particularly the advanced economies, where the fiscal contraction is forecast to occur more quickly. Also, we continue to think of geopolitical tensions as a key risk, particularly between the US and the potential re-escalation of a trade war with China. Europe has still got post-Brexit disruptions going on, and we continue to monitor those. And here in Australia, there remains rising tensions with China, particularly around our exports. So just as a bit of an update of where we're currently sitting, this graph shows the performance for the balanced growth option up to the end of September. And as you can see, the financial year, we're in the blue graph there. We're slightly ahead of the median, but we're sitting at the end of September just below 2%. So we've started the year quite strongly. Pleasing to see. Okay, well that brings me to the end of my presentation, of the formal part of this presentation. Now we've got some time for questions from our members. I will now pass over to Camille McGee, our Executive Manager, Member Engagement, to provide those questions.
Thank you, Simon. We have received some questions from BUSSQ members, and the first one is for yourself, Simon. How does BUSSQ ensure that its returns are above benchmark and competitive with other super funds?
Thank you for that question. One of the things that we do on a monthly and a bi-monthly basis is a regular review of the asset allocation of the fund. And we make changes in line with the outlook on markets. So for instance, over the last 12 months, with interest rates remaining low and likely to stay low for quite a while, we have reduced our exposure to cash and traditional bonds and increased our exposure to more of those sort of non-traditional bond type structures, which includes loans. But we also are very cognizant of maintaining a proper allocation or a decent allocation to defensive assets to protect from downfalls. We continue to monitor our equity managers, our share managers, and have made some changes there, including reducing or introducing a passive manager for global equities to reduce some of the volatility and also to reduce costs for members. In the areas of property, infrastructure and real assets, we continue to look for opportunities to invest in products and assets that will continue to provide some reduction in volatility. And importantly, we continue and always will continue to maintain a diversified portfolio and invest for the longer term.
Thanks, Simon. This second question is a two-part question. Do you still see property, including office buildings, as a good investment, given that more people look to work from home post-COVID? And also, is retail a good investment, given the rise of online shopping?
Thank you. That's another great question. Within our property portfolio, we've actually seen a number of companies looking to extend their leases over the last 12 months or so, and they've actually been looking for additional space. So although people are working from home, there is still some office presence, and a lot of companies still like their employees to come in for collaboration. So we've seen offices slightly change over the last sort of 12 months to include those more sort of collaboration spaces. And on the retail side, it's definitely had its troubles, particularly in New South Wales and Victoria with the extended lockdowns. But we're actually starting to see some strong valuation numbers come through after the 2019-20 financial year, where we saw valuations fall. BUSSQ is an investor in some high quality retail assets in Queensland, Victoria and New South Wales. And interestingly, some of those retail assets are looking to actually change the mix and create more of an experiential space. So they're looking to bring in things like gyms, movies, bowling, and also improving their food and beverage.
Thank you, Simon, for answering those questions. That concludes our annual members meeting for 2021. I would like to thank the Chair, the Directors, and of course, our BUSSQ members.